Trump and Powell have a gold problem. But it's not the kind they'll ever write down in a memo or admit at a press conference. It's the kind that hovers in the background, silent, persistent, and deeply inconvenient. Every time the Federal Reserve makes a new announcement about interest rates, every time political noise starts swelling around those decisions, gold quietly does something the rest of the economy can't seem to manage. It stays solid, unshaken, steady. Now, Wall Street hangs on every word coming out of the Fed. Pundits go into overdrive trying to unpack the meaning behind every little phrase in the latest press release. Are they hawkish? Are they dovish? Is the door open for a rate cut? But amid all that noise, gold doesn't need a press release. Its value proposition doesn't change with the economic weather. And that's the real problem. Because the more the system needs intervention, whether through monetary tweaks or fiscal band-aids, the more obvious it becomes that the machine isn't running on its own. It's being held together by duct tape and policy speeches. Meanwhile, gold? It just is. It does what it's done for thousands of years. It endures. So the question more and more people are starting to ask is, can gold be the solution? Let's start with what just happened this week. The Federal Reserve chose to keep interest rates exactly where they are for the 5th straight meeting. No surprise there. But what raised eyebrows was the fact that there's now visible disagreement within the Fed itself. Two members, Governor Michelle Bowman and Governor Christopher Waller, broke from the rest and actually called for a rate cut. That's not something you see every day, and it got the market's attention. As expected, gold took a small hit. Spot prices dipped. And then Chair Jerome Powell stepped up to the mic with his trademark non-answers. Once again, he gave the usual mix of carefully chosen words about data dependency and economic resilience, but without offering any real direction. And yet, the markets still latched onto every word, parsing the language like scholars studying an ancient text. This obsession with decoding Fed speak points to something deeper. It's not just about short-term policy anymore. It's about the structure of the entire system. And that's where gold comes in. See, gold isn't a reactive asset. It doesn't care about what's going to happen at the next policy meeting. It's not moved by quarterly reports or midterm elections. Its value is rooted in the long arc of history, not in short-term speculation. So let's talk about that. Let's dig into why interest rate changes don't actually matter all that much when it comes to gold's long-term appeal. Let's explore why central banks and institutional investors are quietly stacking up more physical bullion. And let's look at how the political landscape itself is pushing gold into a more central role, because it represents something that's increasingly rare, an asset that can't be manipulated or co-opted. Now, in theory, higher interest rates should make gold less attractive. That's what the textbooks say. After all, gold doesn't pay interest. It doesn't generate income. So if interest rates rise and safe assets like government bonds are offering better returns, why would anyone want to hold on to a shiny metal that just sits there? But in reality, that logic only applies to a certain kind of investor, usually the ones focused on the next 3 months. High-frequency traders, hedge fund managers chasing benchmarks, and quant models that respond instantly to shifts in the yield curve, they all react to rate expectations. And that's why gold prices can swing wildly in the hours after a Fed announcement, even if nothing truly fundamental has changed. That drop we saw in gold prices after Powell's latest remarks, it wasn't some deep shift in investor philosophy. It was just the algorithmic knee-jerk to a lack of clarity. What's ironic is that despite all the models trying to find some magic formula, the long-term relationship between interest rates and gold is pretty weak. Let's look at the data. Back in the 1970s, gold prices soared, right alongside rising interest rates. That was a decade defined by inflation, oil shocks, and political upheaval. People turned to gold not because rates were low, but because trust in the system was breaking down. Then came the 1980s. Rates started to fall, but gold entered a long bear market. That doesn't exactly support the idea of an inverse correlation. Zoom out even further, and the data gets fuzzier. Over the last 50 years, the statistical correlation between gold prices and interest rates is only about 28%. That's not nothing, but it's hardly proof of a consistent pattern. Which brings us to the deeper point. Gold isn't held for income. It's held for security. When institutions, especially central banks, buy gold, they're not betting on price movements. They're making a statement. They're saying, we need an asset that isn't tied to anyone else's promises. And that need is growing. In the last few years, central banks around the world have been steadily increasing their gold reserves. This isn't about speculation. It's about strategy. They're looking at a world that's becoming more fragmented, more unpredictable. Geopolitical tensions are rising, trade alliances are shifting, and perhaps most importantly, currencies are being weaponized. We've seen sanctions freeze reserves. We've seen governments use currency as a tool of coercion. So central banks are rethinking what it means to hold safe assets. And gold is the ultimate neutral reserve. From the perspective of an individual investor, physical gold offers something else that's pretty rare in today's financial system: autonomy. It doesn't rely on a bank. It doesn't depend on a government's solvency. It can't be printed or diluted. There's no counterparty risk. Compare that to sovereign bonds. They might be considered safe, but only until they're not. Bonds can default. They can be restructured. They can be subjected to capital controls. Gold, by contrast, is a bearer asset. You own it outright. No one has to keep a promise for it to hold value. And this is where things get interesting. Because the very existence of monetary policy committees, these panels of economists sitting around trying to decide the right level for interest rates, reveals something profound about the system we live in. If the system were stable, it wouldn't need constant tinkering. But it does. Every few months, we wait for the Fed to tell us what reality is, and that tells you everything you need to know. Gold doesn't work that way. It doesn't need policy. It doesn't require intervention. It doesn't run on trust in government. Its value is self-contained. It just is. And that difference, that's what's becoming more and more attractive, not just to gold bugs or fringe investors, but to serious institutions trying to hedge against a future that's looking increasingly unstable. Now let's get into the part that nobody wants to say out loud, but that everyone is thinking. Is the Federal Reserve really independent anymore? We're told that the Fed operates outside of politics, that its decisions are driven by data, not elections. But over the past few years, that image has started to crack. And when cracks show in an institution that underpins the entire financial system, people start to look for alternatives. Gold is one of those alternatives. Take, for example, the reports that former President Donald Trump floated the idea of firing Jerome Powell during his term. Now, legally, that wasn't really an option. The Fed chair doesn't serve at the pleasure of the president. But the fact that such a move was even considered shows how fragile the norm of central bank independence has become. And let's be honest, Powell's insistence that the Fed remains autonomous rings a bit hollow when you consider how much pressure the institution faces. The boundary between policy and politics is getting blurrier by the day. Independence? It's not a law. It's a convention. And history has a habit of reminding us that conventions can collapse when they're no longer convenient. Internally, we're also seeing more signs of discord within the Fed. The Federal Open Market Committee, long seen as a body of technocratic consensus, is now home to visible disagreement and even political posturing. That makes markets nervous, it makes investors cautious, and it raises uncomfortable questions. Can we rely on these institutions to act in the long-term interest of stability, or are they becoming just another arm of political strategy? When trust in monetary governance begins to waver, assets that exist outside of that system, like physical gold, become more than just a hedge. They become a statement. But there's more. Let's widen the lens and look at the broader fiscal environment the Fed operates in. Right now, the national debt is beyond $36 trillion. That's trillion with a T. Meanwhile, economic growth, it's crawling. The average growth rate in the first half of this year was just 1.2%. That's the backdrop against which Congress continues to pass massive spending packages. Infrastructure, defense, subsidies, bailouts, you name it, all with little concern for how any of it will be paid for. And here's where the Fed gets boxed in. On one hand, it has to keep interest rates high enough to fight inflation. But on the other hand, high rates make it more expensive for the government to service its debt. That puts policymakers in a bind. Do they keep rates up and risk breaking the budget, or do they cut rates and risk reigniting inflation? This is what economists call a policy trap. And when a central bank finds itself cornered like this, one option becomes more and more attractive: financial repression. That's a fancy term for keeping real interest rates, meaning rates adjusted for inflation, negative. In other words, let inflation quietly eat away at the value of money, while keeping nominal rates low enough to manage debt. It's not an official policy, it's more of a shadow strategy. But the signs are there, and guess what? Markets are noticing. Right now, the probability of a rate cut in September has dipped to around 44%. That's down, sure. But the bigger picture still suggests the Fed will have to ease eventually. The pressure is building, and investors are trying to read the tea leaves. Which brings us back to Powell's recent remarks. Once again, there was no real forward guidance, just the usual cautious language: economic resilience, anchored inflation expectations, data dependency. You could probably use AI to generate most of these speeches at this point, but even so, the market hung on every word, trying to detect some hidden signal about where rates are headed. This isn't economics. It's theatre. And that's the problem. When the entire financial world is this dependent on tone and posture and implication, what does that say about the strength of the system? Gold, meanwhile, doesn't require interpretation. It doesn't issue forecasts. It doesn't hedge its language. It doesn't revise its position at the next meeting. It just sits there, unmoved by political drama and unshaken by spin. Now, some investors will argue that the recent dip in gold prices shows its vulnerability. But let's be clear, short-term price movements are not the same as a change in fundamentals. When gold drops because Powell didn't say the magic words investors were hoping for, that's not a referendum on gold's utility. That's a tantrum. Meanwhile, real people, ordinary households, are dealing with the fallout of inflation, trade disruptions, and rising living costs. The Fed can tweak interest rates all it wants, but it can't fix broken supply chains. It can't stop global conflicts. It can't legislate away structural inequality. In short, it can influence the cost of money, but it can't control the real economy. That's where gold comes in again. In a world full of variables, gold is one of the few constants. It doesn't promise growth. It doesn't offer dividends. But it holds a kind of value that doesn't depend on a single institution's credibility. And in times like these, that kind of value becomes increasingly meaningful. At the core of this entire conversation is a deeper issue: trust. The modern financial system is built on confidence. Confidence in governments, in central banks, in legal frameworks. But when that confidence starts to fray, even at the edges, people begin to look for assets that don't rely on trust. Assets that don't need someone to keep a promise. And this is where gold shines brightest. Physical gold doesn't come with counterparty risk. It doesn't require an agreement or a contract. You don't need a functioning bond market or a solvent government to know what it's worth. It's not a claim on something. It is the thing. Its value is intrinsic. It's absolute. And that makes it incredibly rare in a world where most assets are abstracted, derived, and heavily dependent on things outside of your control. That's why, for an increasing number of investors, from private individuals to sovereign institutions, gold isn't just an asset. It's a safeguard. It's a backup plan. It's a way of asserting a level of financial independence that's becoming harder and harder to achieve in a hyper-centralized, hyper-politicized system. So when we look at central bank policy, when we look at the deficit, when we look at the political fights over debt ceilings and budget priorities, we shouldn't be asking, what does this mean for gold tomorrow? We should be asking, what does this tell us about the system's long-term stability? Because that's what gold is really a hedge against. Not volatility, not inflation, not even low interest rates. It's a hedge against the fragility of trust. So let's zoom out even further. Because this isn't just about interest rates. It's not even just about inflation. What we're talking about here is a tectonic shift, one that affects how individuals, institutions, and entire nations think about value, risk, and sovereignty. We've spent decades building a financial system based on layers of abstraction. Money is no longer something tangible. It's credit. It's trust. It's belief in a promise that someone, somewhere, will honor a commitment. Whether that's a central bank, a corporation, or a government, The modern economy functions because we believe it will. But belief is fragile. Belief breaks. What happens when that belief starts to fade? That's the question more and more people are quietly asking. Not in headlines or quarterly reports, but in how they're allocating capital, in how they're hedging exposure, in how they're preparing for a world that looks less coordinated and more adversarial. We're in a moment right now where the global order is shifting. Trade alliances are fraying. Supply chains are moving home. Conflicts are escalating. Sanctions are being used not just as punishment, but as tools of economic control. The dollar, once the unquestioned reserve currency of the world, is now being challenged by bilateral trade agreements that bypass it altogether. In this environment, gold offers something no other asset can: neutrality. It doesn't belong to any nation. It doesn't require a rating agency's approval. It doesn't depend on swift access or dollar clearing arrangements. Whether you're in Beijing, Berlin, or Buenos Aires, an ounce of gold is an ounce of gold. That matters. Central banks have understood this for a while. That's why they've been quietly accumulating physical gold, not ETFs, not futures contracts, the real thing. Bullion, stored in vaults, outside the banking system. It's not about yield, it's about insulation from sanctions, from currency devaluation, from systemic shocks, and private investors are starting to catch on. Now, let's be clear. Gold isn't a get-rich-quick play. It's not going to triple in price overnight. It doesn't move like a tech stock or a cryptocurrency. But that's exactly the point. Gold's role isn't to chase returns. It's to preserve capital across regimes, across currencies, across generations. And in a world where everything is increasingly interconnected and vulnerable to chain reactions, holding something that stands outside that web is a form of insurance. Think about this. A US Treasury bond is considered a risk-free asset. But that's only true if the US government remains solvent, politically functional, and committed to honoring its obligations. What happens when even one of those assumptions comes into question? In the summer of 2023, we saw Congress flirt with default during yet another debt ceiling standoff. Markets got jittery, credit agencies issued warnings, and people started to wonder, is it really unthinkable that the most reliable borrower in the world could one day stumble? You don't need a default to lose faith. You just need enough doubt. Gold, on the other hand, requires no creditworthiness. It doesn't need to be repaid. It's not a contract. It's a claim on nothing but itself. That's not a weakness. That's a strength. And here's another thing. Unlike stocks or bonds or real estate, gold is portable. It's durable. It's divisible. It's discrete. You can hold it. You can store it. You can transport it without needing permission. That gives it a unique appeal in times of crisis, whether that's political, economic, or even personal. We don't often think about this, but financial independence isn't just about net worth. It's about access, it's about control, it's about resilience, and gold checks all those boxes. Now, none of this means you should sell everything and go all in on precious metals. That's not the argument. The point is that in a world where trust is fraying, in institutions, in currencies, in global coordination, having a portion of your wealth allocated to something outside that system isn't just wise. It's necessary. It's not a bet against the system. It's protection in case the system stumbles. We've seen this play out before. Historically, gold has served as a refuge not just during inflationary periods, but during wars, financial crises, and periods of political upheaval. It has preserved wealth through revolutions, currency resets, and collapses in fiat regimes. The reason is simple. Gold doesn't need to adapt to the system. It outlasts it. And right now, the system is more stressed than it's been in decades. When you look at everything happening, the political polarization, the ballooning deficits, the rising debt service costs, the weaponization of currencies, the eroding independence of monetary institutions, it's not hard to see why physical gold is becoming more appealing. Not just to doomsday preppers or conspiracy theorists, but to thoughtful, disciplined investors who understand the value of insurance. Because let's face it, this isn't about panic, it's about preparation. It's about acknowledging that the world is changing and that we may be entering a phase where traditional assumptions no longer hold. A world where diversification isn't just about sectors and asset classes, but about systems and regimes. In that world, gold plays a critical role. It's the ballast in the ship. It's the anchor in the storm. It's the one asset that doesn't ask for trust. It simply earns it through time. So as the headlines swirl and the markets churn and the policymakers pivot, remember this: gold doesn't promise returns. It promises stability. And in times like these, that might be the most valuable promise of all. Now, if you're watching this and wondering where to start, how to think about gold, how to buy it, how to store it, we've got something for you. We've put together a brand new guide that walks you through the 5 crucial steps for investing in physical gold. It covers everything from allocation strategies to vault storage options to common mistakes to avoid. It's comprehensive, it's practical, and best of all, it's free. Click the link below to get your copy now. And if you sign up early, you'll also be invited to an exclusive webinar with the Gold Rate Insight team, where we'll go deeper into these ideas and answer your questions live. Don't wait until the next crisis to take action. Prepare now. Secure your independence. And remember, in a world full of promises, gold keeps the one that matters most: lasting value. Thanks for watching. We'll see you in the next one.